Welcome to Bayanat, the heartbeat of tech in MENA. We bring you raw stories and sharp insights from the founders, investors, and leaders building the region's startup ecosystem.
Mm.
So for today's deep dive, we are pulling from a massive stack of sources. Early pitch decks, interviews, case studies on African supply chain economics. We're charting the rise of MaxAB.
Yeah, specifically looking at the journey of its co-founder and CFO, Omar El-Ghazali. And our mission today is to, well, really cut through the typical startup pathology.
Right.
If you were tuning in to hear about a couple of guys, coding a flashy consumer app over a weekend and waking up as billionaires, you are definitely in the wrong place.
Yeah, that's not this story at all.
Not at all. This deep dive is really a masterclass in operational grit. We're talking brutal unit economics, the reality of physical logistics, and just the sheer discipline required to survive a VC hype cycle.
Which is vital listening for you, whether you're a founder bootstrapping your first MVP or an investor trying to spot a truly resilient model. And the mechanics are just fascinating, especially when you look at where Omar started.
Oh, absolutely.
I mean, we were talking about someone deeply entrenched in like the highest levels of private equity. He was on a super lean 5-person team managing a $3 billion fund for a GCC royal family.
The sheer velocity of that capital is staggering.
Right. Deploying $1.2 billion in just 18 months, writing single tickets up to $500 million.
He was operating at a massive macroeconomic scale, which creates a really fascinating culture shock when you think about it. He goes from deploying $500 million tickets to joining the private equity arm of Egypt's Ministry of Investment.
Right, focusing on greenfield investing.
Exactly. Starting from absolute zero, no existing company, no cash flow, just, a piece of land or a raw concept, and having to build the corporate structure totally from the ground up.
And when you are building from the ground up like that, you naturally start looking at the tech ecosystem.
Mm-hmm.
But Omar admitted in one of the interviews that his initial view of tech founders was pretty stereotypical.
Yeah, he literally pictured guys sitting on beanbags, playing ping pong, and just burning through investor cash.
Right. But it took stepping into the arena as the CFO for Almenus, helping pivot them into food delivery, for him to realize the brutal complexity behind the scenes.
And that realization led him to partner up with his close friend, Belal El-Meharbel, who was fresh out of Kareem at the time.
But they didn't just sit in a room in Cairo trying to invent a brand new wheel, right?
No, their research strategy was incredibly pragmatic. They saw that B2B e-commerce models connecting manufacturers to small retailers were taking off in places like India, Latin America, Southeast Asia.
So they actually flew there.
Yeah, they flew to those markets, sat down with founders who were 3 or 4 years ahead of them, and asked a very specific question. They said, tell us what not to do.
Which brings up, honestly, the most counterintuitive part of their origin story. You have Omar, a guy who managed billion-dollar funds, and Bilal coming from one of the region's biggest tech success stories.
They have the pedigree.
Exactly. They have the pedigree to walk into any VC firm, slap down a slide deck, raise a massive seed round, and hire a huge engineering team.
Yeah.
But instead, and this is wild, they launched MaxAB with a WhatsApp group.
It's crazy. But they operated on this strict philosophy of demand first, software second.
Right.
Because in an emerging market like Egypt, dumping millions of dollars into front-end technology before you actually understand the physical behavior of your user, that's just a death sentence. You have to prove the unit economics first.
So walk us through what that actually looked like on day one. How on earth does a B2B supply chain run on WhatsApp?
Well, it is entirely manual and super unglamorous. They basically hired 4 or 5 sales agents to literally walk the streets of Cairo, going into small independent neighborhood kiosks.
Just knocking on doors.
Yep. And the pitch was so simple. You don't need to change how you do business. Just text this WhatsApp number with the inventory you need, and we will deliver it to your door within 24 hours, cash on delivery.
Wow. So if MaxAB failed to deliver, the kiosk owner lost absolutely nothing.
Exactly. And on the back end, there is no AI routing algorithm. It's literally just Omar and Bilal staring at their phones, manually logging orders into a spreadsheet.
Frantically calling suppliers to source the goods.
Right, and figuring out how to physically get them delivered by the next morning. They were testing the absolute core mechanics, like, can we source this cheaply? Can we deliver it reliably? And will these merchants actually hand us physical cash?
So they pressure tested the whole business model without writing a single line of complex code. But you hit the nail on the head when you mentioned physical logistics.
Yeah, spreadsheets break down pretty quickly when volume scales.
Oh, for sure. You suddenly have to move thousands of physical boxes across a congested city, and this is where they ran headfirst into the core paradox of their market.
The sources highlight this massive macroeconomic contradiction. Africa produces roughly twice the food it consumes, right? The continent is super rich in agricultural output, yet there are widespread shortages and massive inefficiencies.
Because the breakdown happens entirely in the middle. Between a food manufacturer and that local neighborhood shop, there isn't just one distributor. There are like 5 or 6 layers.
It's ridiculous. You have the factory, which sells to a massive national distributor.
Yeah.
They sell to a regional wholesaler.
Who sells to a local sub-wholesaler.
Right. And finally, some guy in a van buys it from the sub-wholesaler and drives it to the local kiosk. Every single time that box changes hands, a markup is added.
And by the time the goods reach the shelf, the price is totally inflated. Not to mention, the data about who is actually buying the product is completely lost to the manufacturer.
Exactly. So MaxAB's goal was to take a sledgehammer to those middle layers. They wanted to buy directly from the fast-moving consumer goods companies, the FMCGs, and deliver straight to the kiosk.
But doing that means you have to physically store and move the inventory yourself. And honestly, normally tech startups are obsessed with being asset light.
Oh.
They want to be the Uber or Airbnb of their sector and not own the trucks.
Yeah.
So why did MaxAB choose the hardest possible path of controlling all this physical infrastructure?
Because in this specific market, controlling the physical assets wasn't a liability. It was the only way to manufacture the ultimate product, which is trust.
Trust.
Think about the kiosk owner. They have bought their inventory from the same guy in a van for 20 years. Their father probably bought from that guy's father. You are asking them to break a multi-generational habit to trust a tech startup.
Right. So if MaxAB outsources their delivery to some third-party logistics company and that driver shows up 2 days late,
then MaxAB wouldn't just lose a single order. That kiosk owner would permanently go back to the guy in the van, and they'd probably tell every other shop on the street to do the same. Reliability is the business.
but taking on all that physical infrastructure usually turns a nimble startup into a slow, lumbering dinosaur. How did they avoid getting crushed by their own weight?
Agility was baked into their real estate strategy. They never bought the warehouses. They never bought the delivery fleets. They rented everything on super flexible terms.
Oh, that makes sense.
The sources show that as their volume exploded, they were outgrowing their capacity every 6 months. Because they rented, they could completely tear down and redesign their physical network twice a year.
So they maintained operational control over the goods without being, chained to the real estate.
Exactly.
Okay, so they control the goods, they prove they can deliver reliably, they build that trust, but then they hit the ultimate ceiling for any small business in an emerging market, which is cash flow.
Oh, yeah, the biggest bottleneck.
Which brings us to this fascinating evolution where MaxAB basically transitions from a logistics company into a financial engine.
And that transition was born out of pure necessity. Because the incumbent players, the huge FMCG manufacturers, gave them zero leverage initially.
Right. Traditionally, those big manufacturers will give established wholesalers, 30 to 45 days of credit to pay for a shipment?
Yeah, but when MaxAB showed up as a new player, the manufacturers demanded cash up front. You want 1,000 cartons of cooking oil, pay us today.
So MaxAB literally had to earn their credit rating cycle by cycle. They proved they could move volume, negotiated just 5 days of credit, then hit their targets, paid on time, got 10 days. Then 15.
Right, until eventually they secured the standard 30 days. And once MaxAB had that 30-day window to pay the factories, they unlocked a massive strategic advantage. They had a float.
Because they are collecting cash on delivery from the kiosks instantly, but they don't have to pay the factory for a month.
Exactly. And instead of just sitting on that cash, MaxAB started passing that credit down the chain to their retailers.
Which is a huge unlock for you listening to Grasp. Over 99% of these kiosk owners are completely unbanked. They don't have credit scores. Traditional banks won't touch them.
Right. So MaxAB essentially stepped in as their bank. They started offering digital wallets, underwriting the shops based purely on their order history.
But wait, a lot of this transaction volume was still happening offline, right? Via cash and phone calls. Until the pandemic forced a massive shift.
Yeah, the COVID-19 lockdowns were a huge catalyst. Before the pandemic, only about 15% of MaxAB's orders came through their smartphone app. A lot of shop owners didn't even have smartphones.
Wow, just 15%.
Yeah, but when global supply chains froze and the offline wholesalers couldn't source goods, the neighborhood shops were backed into a corner. They had to adopt the app. By 2022, App usage skyrocketed to 75%.
That shift from offline to online is the holy grail, because suddenly you aren't just moving boxes, you are capturing millions of data points. You can see what a retailer is searching for, what they abandoned in their cart.
It unlocked incredible personalization, and they took this momentum and started spinning up new business units. They used a startup within a startup model, empowering small teams to own new regions or verticals.
Like the fintech arm and the logistics as a service division. I read that at one point, MaxAB was handling 15% of Amazon's shipments in Egypt, using their spare warehouse and truck capacity.
Yeah, it's pretty incredible.
But let's pause here, because this is where a lot of startups die. If I am an investor and you pitch me a B2B grocery platform, but then tell me you are also running a shadow bank and delivering packages for Amazon, I mean, every new vertical sounds like a massive distraction. How did they avoid losing focus on their core business?
On paper, I agree, it looks like a distraction, but internally, it operates as a meticulously engineered flywheel. Think about the physical mechanics. If MaxAB sends a truck out to deliver groceries and it returns to the warehouse empty, they are losing money on that return trip.
Obviously.
But if they fill that empty truck with Amazon packages on the way back, the truck is now generating revenue in both directions. That pushes their vehicle utilization to nearly 100%.
Which means the baseline cost of operating the truck just plummets.
Exactly. The Amazon revenue basically subsidizes the logistics network. That lowers the unit cost of delivering their core groceries. Cheaper deliveries keep the kiosk owners fiercely loyal. That loyalty generates more ordering data through the app.
And more accurate data allows the fintech arm to underwrite better loans for the kiosks, allowing them to buy even more groceries.
Right. Every single quote-unquote distraction was structurally designed to feed momentum right back into the core e-commerce business.
That is a brilliant way to conceptualize it. And that intense focus on unit economics, making sure every single transaction was mathematically sound, is exactly what saved them when the era of easy VC money abruptly ended.
Yeah, because during that crazy VC boom from 2018 to 2021, money was essentially free. The whole vibe was to subsidize your product, sell at a loss, and capture as much gross merchandise value or GMV as possible.
Just to show massive growth charts to the next round of investors. But MaxAB refused to chase pure GMV by selling below cost.
It requires immense psychological restraint to ignore that hype, especially when competitors are slashing prices to steal your market share. But Omar and Bilal obsessed over cash flow.
They recognized that true profitability lay in capturing those tiny 1 to 1.5% margins left behind every time they eliminated one of those legacy middlemen.
They weren't trying to just inflate a valuation. They were building a self-sustaining machine. So when the market shifted and investors suddenly demanded profitability, competitors just collapsed.
But MaxAB didn't have to change its DNA. The financial discipline was already baked in from the WhatsApp days, which positioned them perfectly for the 2024 Wasoko merger.
Oh yeah, creating the single largest B2B retail network in Africa.
But merging cultures across 11 countries sounds like a recipe for the very extreme chaos Omar faced on day one. I mean, combining two companies of over 2,000 people each, 9 volatile currencies.
And differing legal structures. The sources point out that one company was structured through Dutch legal entities and the other through Delaware C Corp.
Oh, wow. Merging a Delaware entity with a Dutch entity isn't just signing a piece of paper. It highlights that the hardest part of scaling isn't the software, it's the human element and the legal labyrinth.
It's the ultimate test of leadership. The key to survival was absolute alignment between the leadership teams. Before any documents were signed, the executive teams had to be entirely in sync regarding their long-term vision and how they would handle conflict.
Because if the CEOs are misaligned, that fracture cascades down to thousands of workers and engineers.
Exactly. So they broke the integration down into discrete, painfully granular milestones to keep everyone, including 2 entirely different sets of global investors, on the same page.
It's a level of operational grit that is just incredibly rare. And it's fascinating to see that Omar is taking this grit to his next venture in the U.S. now.
Yeah, PSF Network, using AI to fractionalize real estate investing.
Right, essentially building a marketplace where retail investors can access commercial real estate 1 square foot at a time. The industry is totally different, but the fundamental philosophy is identical.
He looks at commercial real estate, sees an opaque, deeply entrenched legacy system with way too many intermediaries, and he is methodically building the infrastructure to bypass them. It's the exact same playbook.
It really is. And that brings us to the ultimate takeaway for you listening right now. MaxAB revolutionized a massive market, Not with flashy tech, but by finding the inefficiencies in an unsexy legacy system and painstakingly building trust. Look at your own industry. What is your equivalent of a broken supply chain? And could the solution start with something as simple as a WhatsApp group?
It's a great question to ponder.
For more stories like this, subscribe to Bayonot's newsletter and stay updated on the latest in MENA's tech and startup ecosystem.